Hello, in this lecture we're going to take a look at cost variance analysis. We will include the direct material variance, including the price variance and the quantity variance, the direct labor variance, including the rate variance and the efficiency variance, and we will take a look at the overhead controllable variance and the fixed overhead volume variance. Alright, so we have the data for the problem up here. We're going to have the standard cost for a single product first. This is the information given, and we're going to say that units, we have the units here, of course, in terms of direct materials. For this case, we have 30 pounds at $4 a unit, and so if we multiply that out for one single unit, then it would be the 30 pounds times $4 each. We would have direct material cost of $120. In terms of direct labor, we have 5 hours, $14 an hour, and therefore we're going to have the $5 times 14. That'll give us the $70 per unit of production of the items we are producing here. Factory overhead, we had a variable portion, which is 5 hours, and we're basing that on the direct labor hours. That's why we have the 5 all the way down, times the 8. And even the fixed portion, we're going to allocate it in this case in the same fashion in terms of the 5 hours of hourly wages, and we're going to assign the $10 in this case. So that's going to be our standard cost for the single product. If we sum these up, we're going to equal a sum function and add up the 120 down to the 50, and that's what we have so far. That's going to be the 280. All right, so then we have the other information that's going to be given to us within the problem. We have the flexible budget information. So we're going to look at the cost variance. In order to do so, we want to look at it in terms of a flexible budget, meaning if we produce more or less than we thought, we're going to adjust our budget to think about what we would expect to happen at that production level. So we're going to talk about capacity here, meaning that, you know, if we can maximize capacity, that would be 100%. If we're at 70% capacity of what we could do, then these are the results that we would expect to happen. So if we were at 70% capacity, we have the production in units of 42,000. That's how many units we would produce. Remember, this data up here is how much it's going to cost for one single unit. So keep those two in mind. We have the standard direct labor hours, so this would be the number of hours we would expect at 70% of capacity. And then we have the budgeted overhead. We have the fixed factory overhead and the variable factory overhead at 70%. Same for at 80%, same for at 90%. That's going to be the flexibleness of the budget. It'll change. We will have different expectations based on different outputs, different output productions. Now we're going to compare that, of course, to what actually happens. So now we're going to say, okay, well, what actually happened? And then let's make our flexible budget in order to reflect what we think should happen at the actual production capacity, which in this case is the 90. So note that this area here is what we're really looking at. I'm going to just go ahead and highlight that. We're looking here because now we know what actually happened, and we were at 90% capacity. So we're not going to compare what actually happened at 90% capacity to a budget based on something other than 90%, which, if you know, before the time period, we wouldn't know exactly what the capacity was. So we have the 90% capacity. That's what actually happened compared to the budgeted information of what could have happened and the budgeted information per unit. Then we have the units produced. We know that at this point what actually happened, and that actually lines up perfectly to what we thought was going to be produced in this case at that capacity, at 90% capacity. And then we have the actual direct labor hours here, which are 265,000. And that's different than what we would think would have happened at the 90% capacity based on our flexible budget. All right, so first we're going to take a look at the standard costs assigned. So we've got the standard costs assigned down here. Now the direct materials is a little bit tricky. So we're looking at units here. So the direct materials, we're going to say, if I say this equals the 30 units of direct materials times how much we think we're going to produce in terms of units, the 54,000. So that's how we're basically coming up with this number here. What we think is going to happen, we'll take 30 pounds and we're going to make 54,000 units. And the unit cost is going to just equal this 4, the 4 right there. And so if we multiply that out, then we're going to have the 1,260,000 pounds times $4 per pound, and that'll give us the 6,480,000. In terms of the direct labor, what we thought is going to happen is going to be just right there, the 270. And notice we're not making any conversion for the difference in the number of hours because we have this at capacity here. So we're doing it at the capacity. That's what our estimate is made from. and we're saying here that we're having the rate being for $14. So $14 is the rate. So I'm going to say this equals this $14, that $14, and then we're going to multiply that out. So we're going to have the 270,000 times the $14, and we have the 3,780,000. And then we have the factory overhead. We're going to base the factory overhead on the same the hours, because that's how we're basing the factory overhead. So that's basically going to be the same 270. And we're going to say the rate, I'm just going to combine the rate here. So between the variable and the fixed, we allocated that out. So we're going to say that's the 18, the 10, and the 8. And we're going to multiply that out. That's the 270 times the 18, which means that's the 4,860,000. Okay, so let's compare that to the actual costs incurred. This is going to be given, right? This is what actually happened. So we actually had this many units compared to the budget of this many units at 90% capacity. We actually had 410 per unit cost in terms of direct labor as compared to 4, which is what we budgeted to happen. And so here's going to be that multiplication out. And then in terms of the direct labor, we actually had the 265 compared to the 270. And we actually had 1375 per hour instead of the 14. And so if we multiply that out, we have this. And then the factory overhead total for the factory overhead cost, we have this, and then the variable portion here. So if we were just to take the standard difference, the difference between these numbers, this is what we actually happened minus what the budget was to happen, the standard costs. And so that would be our difference here. Now the problem is that that difference doesn't take into account the two components that are in the direct materials. One is the fact that there's this difference in the cost per unit. We paid, in this case, more than we thought was going to happen. And the other is this difference in terms of how many units did we use. So when we want to drill down how are we doing, we need to break this total difference out that we would see as one line item between those two things. We got to say, okay, did we waste material or did we pay more for the material than we thought we were going to pay? So we're going to have the same thing for the direct labor. It's going to be this minus this, and we have the same kind of idea. We have this total difference, but there's two things that could happen. One, there's a difference between the rate, the average rate that we paid for the work, and there's a difference in terms of how much work was done. So the two, what happened if work is under or over? The question is, okay, well, did we pay people more or less than we thought, or did people work more or less hours than we thought? Were we efficient with the hours, or were we efficient with the pay? You know, which side are we on here? The factory overhead, I'm going to add these two. So I'm going to say this equals, I'm going to say brackets this plus this, brackets minus the factory overhead over here, because it's combined on this side. And then we have our difference there. And obviously it looks a little funny because I combined these, but I'm going to go ahead and sum this up down here equals the sum of these three items there. So those are our total differences between what actually happened and what the standard is. So now we're going to break these differences out into their components. We're going to start off with the direct material. So I'm going to go ahead and highlight that. I'm going to highlight this and make it green. We're going to look at that. And remember, there's two pieces that could be the factor of breaking that out. One is there's a difference in the cost per unit, and two, there's a difference in terms of the units that were used. We're going to try to drill down on those and see where the actual difference is. First, we're going to come up with these same numbers. I'm going to have this number and this number. I'm gonna recalculate this. I'm gonna make this green. You'll see kind of why. And so I'm gonna say this number is, we're just gonna recalculate it. The actual quantity, that's what AQ stands for. You'll see it often, times the actual price. So we're just multiplying this out, the same thing that we did up here. And if we multiply those two out, we get this number times this number, and that's, whoop, in the wrong cell. It's gonna be this number times this number. And so all we did was recalculate this number in our kind of pictorial format. And then over here, we'll do the same thing on this side. We're going to say, okay, this is the standard costs. We're going to say for materials, we have this amount, and then the standard price, FP standard price is the 4. And we're just going to recalculate this, and we're going to say this equals the standard quantity times the standard price. And we just recalculated this item. So if we were to subtract those two out, which I did here, we would just have this same number up here. So we just recalculated. Those are the same places to start. But now we're going to try to break these out, and we're going to do a different calculation. We're going to have the actual quantity over here. So that's the same actual quantity that we had here. but we're now going to multiply that times the standard price. So we're multiplying that times the standard price over here. And so if we look at these 4 items here, we're basically calculating these 4 items. We'll multiply in these 2 and then the other 2 over there, and these 4 items. Notice that the quantity is the same. We're keeping the quantity the same in both of these calculations. The things that differ is the actual price and the standard price. So we're trying to basically narrow down on the price variance. The thing that differs is the price, and we're using the actual quantity in order to do this calculation. So if we multiply this out, we're taking the actual quantity times the standard price, and we get this number here. Now, if we have the actual, now if we look at the things that are different, which is the standard price and the actual price, we would kind of hope that what actually happened would be lower than what did happen. So if I subtract this out, I would hope that basically this number would be larger than this number. It's not. That means it's an unfavorable difference, which makes sense because this number's higher. We paid more per unit than we budgeted to pay. Okay, so now we're gonna do this. So that's the price variance. That's the first half. Now we're gonna do the quantity variance. So I'm gonna unhighlight these, and I'm gonna unhighlight, and we're basically looking into 1, 2, 3, 4 this side now. So now we're comparing these two calculations: the actual quantity times the standard price, the standard quantity times the standard price. So notice what's different between these two. The standard price is the same. The thing that differs is the quantity. The quantity is the thing that we're differentiating between these two. So we've already done these two calculations. So there's the two calculations. And between the thing that's different, here's the standard quantity, here's the actual quantity. Now we would hope that the actual quantity that we use is less. That would mean that we were more efficient than we thought. And that's the case here. This one is less. Therefore, if we subtract this out, we're going to say this number minus this number. It's going to be a positive difference, a favorable difference here. And now if we take the total difference, I'm going to say this number, which is unfavorable, plus this number that is favorable. That comes back out to our total difference here. So here's our total difference. We basically just broke that total difference out to what we think is the difference due to price variance, the difference in price, and quantity variance, the difference in quantity here. And that's what the breakout is going to be. That's what that breakout looks like. Now, if we just looked at it in terms of a table, and we put these numbers into a table, the direct materials price variance, that is this number that we calculated up here, and it's unfavorable. And then the direct materials quantity variance is this number here, and it is favorable. And then if we add those two up, or it's a subtraction problem, but we're adding it in Excel, we have a total unfavorable difference. So it's a total unfavorable difference, but the whole difference that is unfavorable seems to be due to the price, not to the efficiency, where we actually did better than we would have expected. So